All right, let's dive right into it. Today, we're tackling something that definitely catches the eye in the finance world. It's a fund called Oxford Lane Capital Core, ticker OXLC. And the headline number, an almost unbelievable dividend yield.
Yeah, we're talking, what, around 24% reported, which, I mean, if you're looking for income, that sounds like hitting the jackpot.
It really does. But, as we always say, if someone looks that good.
You got to ask questions. A yield that high can be amazing, sure, but it can also be, well, a huge red flag, a warning sign flashing bright red.
Exactly. And that's what we're here to do today. We've got this source material, and honestly, it doesn't hold back at all.
No, it's pretty blunt. Calls the yield a potential mirage, even suggests the fund might be like a walking zombie. Strong words.
Very strong. So our mission here is to unpack these sources for you. Understand, based on this material, what OXLC actually is. Why are these sources so critical of that huge yield? And, crucially, what are the risks they're pointing to? We want you to have the full picture, at least according to the specific analysis.
Right. We'll look at the structure, how that payout is actually funded, or maybe not funded by earnings, as the sources hint, and, the longer-term view presented here.
Okay, let's start with the basics then. What is OXLC, according to the sources? They say it's a CEF, a closed-end fund.
That's right. But it's a specialized one. It focuses on a very particular corner of the market. It's collateralized loan obligations, CLOs, and specifically the equity part of CLOs.
Okay, CLOs. We hear that term thrown around.
Yeah.
Can you break that down simply, based on what the sources say?
Sure. So imagine a big pool of corporate loans. Often, these are loans to companies that maybe aren't the most financially sound, less than investment grade sometimes.
Yeah.
These loans get bundled together, and then that bundle, it's sliced up into different layers, kind of like a lasagna maybe. They call them tranches.
Okay, different slices.
Yeah. And the ones at the top, the senior tranches, they get paid first when the loan payments come in. So they're considered safer, relatively speaking.
Makes sense. And the equity tranches, that's OXLC's playground.
That's exactly where OXLC invests, according to these sources. The equity tranche is way down at the bottom. It only gets paid if and after all the other layers above it, the senior debt, the mezzanine debt, have gotten their share.
So last in line for payments.
And first in line for losses. The sources use a pretty stark analogy, actually. They say holding CLO equity is like being the last person on the Titanic demanding another cocktail while the ship tilts at 45 degrees.
Wow.
Yeah. You're the first one hit if those underlying companies start having trouble paying their loans.
Got it. So riskiest part of a bundle of maybe already risky loans, which brings us back to that giant yield. 24%.
Yeah.
How do the sources explain that? Is it real income?
Well, this is where the analysis gets really sharp. They basically say a yield like that means one of two things. Either the fund is just knocking it out of the park, performance-wise, generating incredible earnings, or, and this is their direct quote, it's a walking zombie paying you with its own decaying limbs.
Oof, that's blunt.
Extremely. And they don't leave you hanging. They say, spoiler, it's number two.
Okay. So let's unpack why they land there. They mentioned the math doesn't math. What's behind that?
The main point highlighted is the fund's net investment income, or NII. That's basically the actual profit from its investments after you take out expenses. And the sources say very often OXLC's NII just doesn't cover the amount it's distributing to shareholders each month. Not even close sometimes.
Right. So if the actual earnings aren't enough to pay the bills, so to speak, where's the cash coming from?
And that leads us to a really critical concept. The sources hammer home return of capital, ROC.
Return of capital.
Yeah. They explain that a big slice of that monthly check you might get is often classified as ROC.
Which means it's your own money coming back to you, your initial investment.
That's exactly it. The sources have this great analogy. It's like lending a friend $100, and then you're super happy when they give you back $80 and, I don't know, a couple slices of pizza.
Yeah.
You got cash, yeah, and maybe some pizza. But most of that cash was just your original $100 coming back. It wasn't profit your friend made.
That really flips the script, doesn't it?
Yeah.
You think you're getting rich income, but you might just be getting your own capital handed back, minus a bit.
Precisely. And this ties directly into the next huge issue the sources raise. They call it the silent scream. It's about the net asset value, or NAV.
NAV. That's the actual underlying worth of the fund's assets per share.
Right. Exactly, the real value. And the sources show a really stark picture here. They point out that back in, say, 2013, OXLC's NAV was around $10 a share.
Okay.
Fast forward to 2024, it was down around $3.50 and, generally trending lower.
Wow, that's a massive drop. That's not just the market going up and down.
No, the sources are clear. They don't call it volatility. They call it NAV erosion. They argue the fund is literally eating itself alive. It pays out more than it earns, so it funds the difference partly by, giving back capital, which shrinks the asset base over time.
But what about the argument, who cares about the NAV as long as I get my monthly check? You hear that sometimes.
They anticipate that argument directly, and they counter it pretty forcefully.
The house on fire analogy.
That's the one. That's like saying, who cares if my house is on fire? I'm warm, aren't I? It's a vivid way to say ignoring NAV decay is just ignoring the fundamental health, or lack thereof, of your investment.
So why does NAV matter so much here, according to this analysis?
Well, like the sources explain, the NAV is the foundation. It's the actual stuff backing your shares. When it's consistently shrinking like this, it's a huge warning light. It signals the fund is probably overpaying its distributions relative to what it's actually earning, or it's taking losses on its CLO investments, or it's diluting its shareholders.
Or all three.
Or, as the sources state pretty clearly regarding OXLC, it's likely all of the above.
Okay, dilution. That sounds important. The sources bring up something called at-the-market offerings, ATMs, labeled reverse alchemy. What's that about?
Right. So OXLC frequently issues brand new shares of its stock directly into the market through these ATM programs.
Which raises money for the fund, I guess.
It does raise capital, yes. But the sources highlight a major downside. It dilutes the existing shareholders.
The pizza party analogy they used. More guests show up, everyone's slice gets smaller.
That's the one. Pretty easy to grasp. But the sources say it's actually even worse than just smaller slices. The real kicker is that these new shares are often sold at whatever the current market price is, even if that price is below the fund's actual net asset value per share.
Wait, hang on. They sell new shares for less than the underlying assets are worth.
That's the mechanism described in the sources. They literally call it existing shareholders lighting dollar bills on fire.
Ouch.
Yeah, because you're bringing in new money, but at a discount to the real value, which effectively waters down the value for everyone already holding shares. It can work okay as long as money keeps flowing in, people reinvesting, but the sources warn that game starts when that changes.
Okay, let's recap based on this material. We've got a fund in the riskiest slice of complex debt instruments.
CLO equity, yeah.
Paying out distributions that aren't fully covered by its actual earnings.
Often relying on return of capital.
Which leads to this steady, significant NAV erosion.
The shrinking pie.
And on top of that, it's frequently diluting existing shareholders by selling new shares below NAV.
Got it. That's the picture the sources paint.
It feels like that underlying engine, those CLOs, would need to be incredibly reliable and profitable to make this whole thing work long term.
And, the sources argue pretty much the opposite. They call the CLOs themselves the hidden risk machine. Remember, fundamentally, OXLC is making a bet, a leveraged bet often, that these baskets of corporate loans, many not highly rated, will perform well enough, that defaults will stay low enough for money to actually flow down to that bottom equity tranche.
And the big risk for OXLC shareholders holding that equity piece.
They're the first ones to feel the pain, the shock absorbers. If companies start defaulting on those underlying loans, the equity tranche is the first part of the CLO structure to lose money. Its payments can dry up fast.
Have we seen signs of this?
The sources point to periods like the COVID disruption back in 2020 and the more recent period of rising interest rates. They describe OXLC's performance then as wobbly, suggesting the engine isn't exactly bulletproof.
So the really critical question the sources seem to be asking is, what happens if we hit a proper recession, a real credit crunch where defaults start spiking significantly?
Right. And their assessment is pretty stark. In that kind of scenario, they predict the CLO equity tranches OXLC holds will just hemorrhage cash. The income flowing into the fund could plummet. And if that happens,
the distributions get cut drastically.
Exactly. The very high payout that attracted people in the first place could be slashed, or maybe even disappear entirely. The sources say the distribution might seem stable, month after month, until it suddenly doesn't, killing the main reason most people own it.
Makes total sense. The riskiest part breaks first when the system gets stressed.
Yeah. But what's really interesting, according to this material, is just how powerful that monthly payment can be psychologically for investors. They have a section called, "But It Pays Monthly," calling it the catnip.
Right. The lure of that regular income stream.
Yes.
Especially if you're retired or just focused on cash flow.
Totally understandable. But the sources issue a strong caution here. Don't confuse the frequency of the payment with the quality or sustainability of it.
The sawdust analogy.
Monthly cereal with sawdust isn't fixed by frequency. Just because it shows up regularly doesn't mean it's good for you. The danger, they argue, is this consistent-looking high yield tempts people to chase the income without fully grasping the underlying structure, the ROC, the NAV decay, all the risks we've talked about. Creates a false sense of security, they say.
And just to add more complexity, the sources mention leverage, right? Borrowed money.
Yep. Another layer of risk. OXLC uses leverage, borrowing money, to try and boost its returns from those CLO investments. The sources call it pouring gasoline on the fire.
Because leverage cuts both ways.
Exactly. It magnifies gains if things go well, but it magnifies losses even more dramatically if things go badly. The analogy used, like juggling chainsaws on a trampoline, exciting but dangerous. One slip. Big consequences.
Okay, so high-risk underlying assets, questions about distribution sustainability, NAV erosion, dilution, leverage, anything else?
Oh, yeah. There's the tax trap.
Tax trap.
Especially if you hold OXLC in a regular taxable brokerage account, the distributions you get aren't usually simple qualified dividends. They can be this confusing mix of ordinary income, maybe some capital gains, and as we discussed, that return of capital. The sources call figuring this out for your taxes a potential nightmare.
And that return of capital piece.
Yeah.
It's not tax-free forever, is it?
No, definitely not. The sources are clear. ROC reduces your cost basis in the shares. So, while you might not pay tax on that portion immediately, your actual investment cost is going down, which means when you eventually sell your shares, you'll likely face a larger capital gains tax bill, potentially even on the capital that was simply returned to you over the years. It catches up with you.
Wow, okay. So despite this whole list of warnings and complexities outlined in the sources, people are obviously still drawn to OXLC. The material talks about this, right? The cult of OXLC.
Yeah, it's a really interesting point on investor psychology. The sources describe this kind of emotional connection some investors seem to develop with stocks that send them regular checks. They point to comments you might see online, stuff like, hey, I get $400 a month from OXLC, love it, or who cares what the price does as long as it pays?
Or my favorite you mentioned earlier, NAV is for nerds.
Exactly. That one really captures it. The sources basically call this yield worship,
Wow.
an approach driven more by the immediate cash flow gratification than by, looking under the hood at the fundamentals.
And this leads to ignoring the risks.
That's the argument. Blindness to the structural issues. The sources hammer the point. Based on their analysis, OXLC isn't some safe, steady dividend payer like, say, a utility company. It's a complex, leveraged play on a risky segment of the debt market with, in their view, a structurally decaying capital base, that huge 24% yield. They see it not as proof of success, but as a symptom of the underlying problems and risks. The market demands that kind of yield to compensate for taking on those risks.
So given this highly critical view from the sources, if someone's looking for income but wants to avoid what the sources call a return-destroying magic trick or setting your hair on fire, what alternatives do they suggest?
Well, first they acknowledge that the desire for income is totally valid, but they stress that the goal should be sustainable income generated from real, ongoing business activity or cash flows, not this kind of capital return con job, as they put it.
Makes sense. So what categories do they point to?
They suggest a few areas worth looking into. First, covered call ETFs. They give examples like JPI, maybe QYLD. These funds typically hold a portfolio of stocks and then sell call options against them. The income comes from the premiums collected on those options. It's derived from the market, from volatility.
The yields there.
Generally lower than OXLC for sure, maybe in the 7% to 12% range, ballpark. But the key difference, according to the sources, is the source of that yield. It's seen as potentially more sustainable because it's linked to underlying stock values and option market dynamics, not CLO equity waterfalls.
Okay, so different mechanism. What else?
Second, they mention looking at certain business development companies, BDCs, specifically those with a history of sustainable payouts. Examples given were Maine or IRCC. BDCs typically lend money directly to medium-sized private companies. Often they hold debt that's higher up in the capital structure than CLO equity, maybe secured by assets. The sources suggest this can offer more transparency and potentially more stability than the opaque world of CLO equity.
Right. And the third category.
Back to basics, really. Well-established dividend aristocrats. Companies with super long track records of not just paying, but consistently growing their dividends year after year.
Right. See.
Think Johnson & Johnson, Procter & Gamble, Coca-Cola, the big stable names. Now, the yield won't be anywhere near 24%, not even close. But the income is backed by decades of real operating profits from established businesses. The sources kind of frame it as choosing between trying to sleep well at night versus potentially torching your NAV chasing extreme yield.
That's a powerful contrast. Okay, so bringing it all together, the sources end on a pretty stark note about what happens if those underlying risks, especially a bad turn in the credit cycle, actually materialize.
Okay.
When it goes boom.
Yeah, and again, no sugarcoating. Their prediction is, if corporate defaults rise significantly, those CLO equity tranches OXLC owns, they'll hemorrhage cash. Simple as that. The income flowing into the fund could basically collapse, and the consequence for shareholders.
A distribution gets hammered.
Or eliminated. And because the NAV, the asset base, has already been worn down so much over time.
There's no cushion left.
Exactly. Very little buffer. The sources paint this picture where that tempting 24% yield just vanishes, leaving investors holding shares that have lost significant value and might pay little or nothing going forward. Their warning is crystal clear. You really don't want to be holding this kind of asset when the tide goes out. And history suggests the credit tide always turns eventually.
So wrapping up our deep dive into this specific set of source material, the overwhelming message seems to be a 24% yield, especially from a structure like OXLC's, shouldn't be seen as a green light. It should be a massive warning sign.
Right. It smells like smoke, as they put it. The argument is the yield has to be that high precisely because of all the risks involved, the CLO equity risk, the NAV erosion, the ROC, the leverage. It's the market demanding huge compensation for taking on what the sources see as enormous risk. It's a sign something is potentially broken, not strong.
And the final verdict from these sources.
They call it not a real income strategy, but a return-destroying magic trick. Their analysis concludes that this erosion of capital is almost baked into the model long-term, unless something fundamental and unexpectedly changes for the better.
And that final piece of advice?
Super blunt. Don't set your hair on fire. You're not getting warm. You're getting cooked.
Wow. Leaves you thinking, doesn't it?
It certainly does.
So maybe the big takeaway for you, the listener, after hearing this breakdown of these particular sources, is just that fundamental rule. Don't chase yield blindly. A number that seems too good to be true probably requires a lot more investigation.
Absolutely. You need to understand how the yield is made, look hard at the health of the underlying assets that NAV, and really get your head around the structural risks, especially with complex things like CLOs.
Sustainable income, based on this analysis, comes from solid foundations, not financial engineering that returns your own capital or takes huge bets. That sky-high yield isn't necessarily a gift.
It's an invitation, maybe even an urgent one, to look much, much deeper.
Definitely something to keep front of mind when you see those eye-popping yields out there. You have to understand the why behind the what.
Couldn't agree more.